Good morning, everyone, and welcome to this morning's webinar, The Emerging Issues in the Expiring-Use Affordability Crisis. I'm Winnell Belfonte with CohnReznick. I lead our affordable practice in the New York metro area, and welcome you to our webinar this morning. We thank you for taking time out to join us. This morning's webinar is sponsored by Goldstein Hall and CohnReznick. In order to receive CPE for this morning's webinar, you have to complete at least 75 minutes of viewing the webinar and 3 of 4 of our polling questions, which will be pushed out throughout the webinar. This morning, our discussion will be led by 3 panelists. First, we have Brian Markowitz, a partner at Goldstein Hall. Brian works in the construction space and affordable housing and spends a lot of his time on construction litigation and contracting and real estate litigation. We also have Mark Kavanaugh of CohnReznick. Mark is a tax partner and works in the affordable housing practice in the New York metro area. We're also joined by Brian Hsu, who is also a partner with Goldstein Hall. Brian focuses his time on affordable housing development, banking, and real estate finance. Goldstein Hall is a full-service real estate law firm that concentrates on affordable housing and community development, with the primary areas of focus including development, banking and finance, commercial leasing, corporate formation and governance, nonprofit formation and governance, and real estate law. CohnReznick is a national audit and tax and advisory firm founded in 1919. We're headquartered in New York, and our largest practice area is real estate with a significant concentration in affordable housing. So to get us started, we'll start with our first polling question, just trying to get a sense of how much you all know about the subject matter. And if you can, answer the question, and we'll take a look at what our results are. We have about 40 seconds to respond to the question. Great, so we have our results, and it looks like about half of the audience know a little bit, and about 1/3 would like a little bit of a refresher. And we do have some people who know a lot, so we probably will get tons of questions throughout. We do encourage that you submit your questions. We're hoping that at the end we will have time for some Q&A, and if there's a burning question that you have, you can submit through the Q&A button at the bottom of your screen, and we'll be sure to get to your answer. If we don't have time for your discussion today, we'll be sure to follow up with you after the webinar. And to kick things off, we'll have Brian Markowitz start with the statutory framework of the Low-Income Housing Tax Credit project. So Brian, I'll turn it over to you.
Thank you, Winnell. The statutory framework for the LIHTC projects basically starts with the 1986 Tax Reform Act, which was signed into law by President Reagan, and it is the largest federal subsidy for the development and preservation of affordable housing, and is one of the federal government's primary policy tools for encouraging the development and rehabilitation of affordable rental housing. Since it was established by the Tax Reform Act in 1986, LIHTC has financed the development and preservation of more than 2.1 million units in over 28,000 developments across the country. Owners or developers of projects receiving LIHTC credits must meet an income test for their tenants and a gross rental test. In order to qualify, at least 20% of the project's units must be occupied by tenants with an income of 50% or less of the area median income adjusted for family size. At least 40% of the units have to be occupied by tenants with an income of 60% or less of the AMI, or at least 40% of the units are occupied by tenants with income averaging no more than 60% of AMI, and no units can be occupied by tenants with income greater than 80% of the area median income, AMI. These federal housing tax credits are awarded to developers of qualified projects through a competitive application process, which is administered by state housing finance authorities. Developers either use the credits or sell them to investors to raise capital for the real estate projects, which in turn reduces the debt or equity contribution that would otherwise be required of developers. The types of projects eligible for LIHTC credits are apartment buildings, single-family dwellings, duplexes, and townhouses. Projects including more than one building are also eligible. Tax credit project types vary by the type of the tenants served, and housing can be for families or special needs populations, including the elderly. Because the general partner in these projects is typically a not-for-profit entity, they generally cannot utilize the tax credits, nor can they afford to finance the project on their own. This gives rise to the fact that the usual LIHTC project is structured with a general or not-for-profit partner receiving either 1% or 0.1% interest in the project, and the investor partner or the investor limited partner having a 99 or 99.9% interest in the limited partnership that's formed to own the project. This permits them to utilize the tax credits throughout the compliance period, which is a 15-year period according to the IRS code. Because of this structure, the IRS code provides that the not-for-profit general partner must be provided with a right of first refusal to purchase the property after the 15-year compliance period for a minimum purchase price, which the code defines as outstanding debt plus the exit taxes. On our screen right now is the text of IRS code section 42I7, which contains the right of first refusal. The right of first refusal provided for in this section is a safe harbor provision that must be granted to the general partner or the investor partner will not be permitted to receive the tax credits. It is an important part of the LIHTC process and one that is designed to ensure that at the end of the 15-year compliance period, when the investment partner has exhausted its tax credits and therefore has no continuing interest in the project, that they will exit the project, and then the project will remain in the not-for-profit's hands, and the available stock of affordable housing will be continued in perpetuity. This right of first refusal is also important in that state and federal governments have made significant investments into these projects, and those investments are generally for longer than the 15-year compliance period or even the 30 or 40-year regulatory period. The government made a long-term investment into the project, and such investment should not fall into the investor partner's hands and therefore deplete the available stock of affordable housing. And that's the goal of the Section 42 right of first refusal. So what is a right of first refusal? Under common law, a right of first refusal is typically one where the holder of the right of first refusal has a preemptive right to purchase the underlying property when the owner has accepted an offer to sell the property. The holder of the right of first refusal must meet or exceed the accepted offer's price and exact terms in order to trigger the right of first refusal. Underscoring the typical common law right of first refusal, the holder of the right generally needs to accept all the terms of the original offer and exceed the terms, including meeting or exceeding the monetary terms of that offer. Similarly, a purchase option generally entitles the option holder to purchase the property at a specific price under specific terms. Because the terms of the option are expressly set forth in advance, the holder can typically compel even an unwitting owner to sell so long as the terms of the option are satisfied. However, A Section 42 right of first refusal is not a typical common law right of first refusal. Here, the holder of the right of first refusal does not need to meet or exceed the price or terms of an existing offer. Indeed, because the purchase price is preset as the outstanding debt plus the taxes, the Section 42 right of first refusal holder will be able to underbid any standard offer. While this has led to issues because the right of first refusal in this scenario may never actually come to be exercisable because they will always be able to underbid a potential purchaser. Because of this, a bona fide purchaser will often not go through the time and expense of putting together an offer, only to have someone say, no, I'll take it for $1 plus the outstanding taxes. Okay. So because of this, the Section 42 ROFR does not require that a bona fide offer be made. It does not require that there is a decision to accept the offer. Otherwise, Section 42 ROFRs may never be triggered, and this would frustrate the purpose of the LIHTC program and would jeopardize the available stock of affordable housing or prevent needed capital improvements to existing projects. It's also important to note that a right of first refusal is only one way for the investor to exit the project. Other methods which are common include the right to purchase or a purchase option. In this type of scenario, it's a common provision that typically provides that after a certain point during the compliance period, the general partner is given the right to purchase the investor partner's interest or the project itself for a set amount. The purchase price is usually set at the greater of fair market value or outstanding debt plus taxes. Of course, what constitutes fair market value is often a point that gets litigated and discussed throughout the process. Other common methods to exit out of a project is the qualified contract process pursuant to IRS Code Section 42H6E, the sale or redemption of the investor's interest, put or call options. You can have a sale to a qualified entity. You can have a negotiated exit, and the list, basically can go on and on. So in the last several years, investor partners who are looking for alternative streams of revenue, or an investor partner may have sold their interest in the later years of the compliance period to aggravators who did not receive the revenue of many years of the tax credits and are now looking to convert the project to a revenue stream. As you can imagine, litigation has popped up over these issues. 3 recent cases underscore the various litigation points on year 15 litigation. In Erie County, we had a recent case called Centerline Fleet Housing Partnership versus Hopkins Court Apartments. In that case, the court was faced with the question of whether a general partner's election to redeem the limited partner's interest in the low-income housing tax credit partnership would trigger the liquidation provision under the partnership agreement. The court ruled that in that case that because the partnership itself still owned all or substantially all of the assets of the partnership, the court treated the redemption as a hypothetical sale and noted that the limited partner was not relinquishing its ownership interest in the property, but rather its interest as a limited partner in the ultimate partnership. So basically the court was able to segregate out the ownership interest in the underlying property as opposed to the ownership interest in the limited partnership itself. More recently in Florida, the Florida District Courts in Opa-locka Community Development versus HK Aswan, the court confirmed the Section 42 right of first refusal, that all is necessary to trigger a LIHTC right of first refusal is for the owner of the development to manifest an intent or willingness to sell the development itself. And because the contract giving the the not-for-profit Section 42 right of first refusal contain no other preconditions, it's not necessary for the owners to have received and entered into an enforceable purchase agreement before the not-for-profit general partner had the right of first refusal triggered and enforceable. Similarly, the Riseborough case is a case that's currently being litigated in the federal courts here in New York. In this case, the not-for-profit entity is seeking to enforce its right of first refusal. In this case, the entity, the not-for-profit entity is given the right of first refusal in the contract to sell the property pursuant to the section that enforced the right of first refusal, and the investor partner there is claiming that they are, quote, a long-term holder of assets and is preventing the sale. This is going to be a case that is winding its way through the courts now, but to not permit the general partner to exercise its right of first refusal pursuant to Section 42 would basically be the antithesis of what a Section 42 ROFR was designed for and what the LIHTC program itself was designed for. So I notice there's a couple of questions on this.
Yes,
first question.
Okay, go ahead. Mm-hmm.
Yeah, I mean, I don't mind taking the questions now. We'll take 2 minutes. It says, does the code specifically state bona fide offer not needed to trigger the right of first refusal, or is it not specifically addressed and therefore assumed not needed? The code itself doesn't say that it does not need a bona fide offer. There's been several court cases, both in Massachusetts. There's been cases in Florida now that have both gone through and have said that you don't need a bona fide offer to trigger the right of first refusal. The general partner itself has that ability to trigger the right of first refusal. Can you expand upon the GP's option to purchase at the greater fair market value or debt plus taxes? Specifically, what is the difference between the minimum requirement of debt plus taxes and the greater fair market value or debt plus taxes? So I think what you're talking about here is the difference between the right of first refusal has a statutory minimum purchase price of debt plus the outstanding taxes versus the purchase option, which is a more contractual right and not necessarily as statutorily driven. And given the fact that it's not, most of those contracts provide that it's that the purchase price of the purchase option is triggered at the greater amount of what's deemed as fair market value or the minimum purchase price is set forth in Section 42. So fair market value, it's an evaluation issue. It's something that where it's a valuation issue. You're going to have an appraiser come in and determine what the fair market value is. The contract may provide for multiple appraisers, for specifics on selecting those appraisers, and all that. Outstanding debt plus taxes is something more, you can kind of look at it exactly and know exactly what it is, where the fair market value is more of an appraisal process. Okay.
Thank you, Brian. This now brings us to our second polling question. And so we're interested to find out what role you play in the affordable housing transaction. Are you an attorney, a developer, a management agent, or neither of those options? If you can select your answer, in about 40 seconds, we'll take a look at the results. So it looks like we have a large group of developers participating today, and an equal group of neither an attorney, developer, or managing agent. So thank you for responding. We're now going to turn it over to Mark Kavanaugh to walk us through the impact and the implications to the partners' capital accounts. Mark?
Good morning, everybody. So if we're going to analyze some of these options that we have to pursue with year 15 exiting, we're going to have to do some quantitative analysis to perhaps use this to make our best choice for our best outcome. So in order to do this quantitative analysis, one of the first things that we're going to want to key in on and address are, where do the partners' capital accounts stand at this point? We could be looking at this well in advance of year 15, some point in time following the tax credit, the 10-year tax credit stream, but before the end of the 15-year compliance period, we might be best suited to maybe take a look, do some quantitative analysis, see where things stand, and try to come up with a plan that best suits our needs. But one of the first things we're going to take a look at is the partner's capital accounts. Now, what exactly is a partner's capital account? We should at least have that type of baseline understanding. So I like to refer to the partner's capital account as the partner's scorecard. It's a cumulative scorecard, which every partner initially will start with a 0 capital account, and then it is subsequently increased by any capital contribution, typically cash, that is placed into the partnership as equity, and then that is increased or decreased over time on an annual basis, either by allocations of taxable income, or more typically allocations of tax losses. So those increase and decrease your capital account respectively. Additional capital contributions, should that be needed, will increase your capital account. Any cash flow distributions paid out to a partner will decrease it. So these fluctuations are measured on an annual basis. And so one can reference at any point in time where these capital accounts stand. If you're trying to reference where your capital account stands at any given point in time, typically at the close of a year, the best place to do that is to reference the entity's partnership tax return, and to reference the partner's K-1s, which are what's issued annually to each of the partner of the partnership, and outlines each of their items of income, credits, cash flow distributions, equity contributions, and so on and so forth. So that you should be able to find that if you're trying to reference it on the tax return. I warn folks not to go to their audited financial statement in order to find out where their capital accounts stand, because those are almost always maintained and reported on a GAAP basis, generally accepted accounting principles. That's a different accounting methodology and does not typically correlate to income tax basis. So again, if you're trying to find out where you stand, please reference your tax return. So after referencing your capital accounts, you may notice that one or more of the partners might have a negative capital account or a positive capital account, and each of those has some connotations to them. When you have a negative capital account, one can infer that there's going to be an income recognition event to that partner at some point in time as a result of that negative capital account balance, even if there's no cash distribution to support that. What that negative capital account really represents is that you have extracted more out of the partnership, either in tax losses or or cash distributions, but you've taken more out of the partnership than you've put in your equity contributions. So that will eventually turn around as a taxable event to that particular partner. So in the year of an exit, one of the kind of back of the envelope things one can do to try to figure out what the income tax impact of that exit to a partner would be is to compare the amount of cash that is received by that particular partner versus their negative capital account balance at the beginning of that year of the exit. So in an example, you might have a partner with $1 million deficit, okay, a negative capital account. If they received, say, $500,000 in the year of the exit, ultimately their income tax impact would be that $1 million negative, $500,000 cash, resulting in $1.5 million of taxable income to that partner in the year of the exit. One more point to note out is that you will often see negative capital account balances in 4% tax credit deals because those tend to have smaller equity contributions and finance more with debt than you do with your 9% tax credit deals. So what does a positive capital account indicate? Well, it indicates that there could be potentially a loss recognized by the partner in the year of the exit, that there may be excess equity or basis left in that partnership that ultimately will result in a taxable loss in the year of the exit to that particular partner. It may also indicate that there could be required distributions to a partner with a positive capital account upon a liquidation of that partnership. So we'll address that a little bit later in my segment. But one of the key elements here I wanted to point out is, please make sure that you review your partnership agreement to understand the mechanics and the terms involved and incorporated into that agreement. Similar to what I had mentioned with respect to the negative capital account, with respect to a positive capital account, the taxable gain or loss can generally be considered to be the differential between the amount of cash one might receive in that capital event, during the exit, versus the amount of positive capital at the beginning of that year of the exit. So just to give a very simplistic visual here with respect to tracking capital, you can see here this is just a straightforward example where you have $3 million of equity contributions, the majority of that, of course, coming from the investor limited partner. And then you've got a stream of 12 years of tax losses that are pretty much generated or driven by depreciation deductions. And that following the close of our year 12, we can see that the investor limited partner has about $1.3 million of negative capital. And again, there's some indication there that there's a taxable event awaiting that limited partner down the road. And that, certainly would factor into, a scenario with a right of first refusal and executing that when there are exit taxes involved. So one can infer that there's going to be an exit tax liability in this particular scenario by virtue of this negative capital account when we're doing our analysis. So another part of our quantitative analysis then is we certainly want to visit the distribution section of our partnership agreement to determine in a sale scenario who would be entitled to what proceeds out of a sales scenario and a potential liquidation of the partnership. So as I state here, you usually find that in the partnership agreement in the distributions section, and you want to make sure that you're referencing there's typically two waterfalls that exist in a partnership agreement, and one relates to operating cash flow, if there's significant of that that exists, and then there would be a secondary waterfall of cash flow with respect to capital transactions, which encompass refinancings and sales events. So I referenced a live actual partnership agreement as an example, and pulled some of the relevant language out of that to demonstrate what we mean by the waterfall. So you'll have, in a capital transaction, you would have residual cash after selling the property at fair market value and paying off your debts. You're going to have a residual cash from that to distribute to the members. And while items are typically allocated 99% and 1%, or 99.9% and 0.1% between the limited partner and the general partners, you'll typically find that the cash flow waterfall with respect to capital transactions has a different sharing mechanism to it. So in this particular sample, the first thing we're supposed to do with our proceeds is to pay off the liabilities of the partnership. Second, to fund any reserves that might be deemed required. Third would be the payment of any outstanding operating expense loans. For instance, if the GP or an affiliate had to fund operating expense loans, those would come out next at that point. And then finally, to the extent that anything is left over, in this example, 20% of the proceeds would be to the limited partner and 80% would be to the general partner. So this is a typical deal where we see the general partner have some economic upside to the deal. So in a partnership agreement, everything should be in concert with respect to how profits and losses from a tax standpoint are allocated to the partners, and cash flow that's being distributed to each of the partners. So if, as part of this quantitative analysis, again, in determining not only who gets what in cash, but who is allocated what with respect to income and loss, we have to visit the profits and losses allocation language of the operating or the partnership agreement. Generally, in order to make sure that all of the partnership items are being allocated as intended, in particular the depreciation and tax credits, that those are going to the investor, there are usually general partner allocation instructions whereby only, say, 0.01 in this example would be allocable to the general partner, and 99.9% of those items on an annual basis would be allocated to the limited partner. Sorry, I skipped ahead here. So, however, when you have a capital transaction, in this particular example, there are also some specific instructions here that tell us how we should be allocating the capital, the gain or income event that is being recognized upon this sales transaction. And in this example, it says, first we allocate profit to the extent of negative capital account balances. And then after that, we allocate items of taxable gain to each of the partners such that that allocation of the gain mirrors what they're receiving in the cash flow distributions from what we had done previously, trying to figure out who's entitled to what through the waterfall calculation. So again, a well-drafted partnership agreement should have, a correlation between, over time, it will have a correlation between the amount of cash investment and cash distributions that are put in and received by a particular partner and the amount of income or loss that's allocated to each partner. Again, with the concept of everybody would ultimately start with a zero capital account and end with a zero capital account after the lifespan of the investment, and we've allocated all our items, and everybody has received, should they receive cash flow distributions, that all of those things over time, you start at zero and you end at zero. One of the other elements that should be paid attention to, and this can come into various scenarios, but there's often a provision that a liquidating distribution, in other words, we're wrapping up the partnership activities, and we're dissolving it, and we're making a liquidating distribution of whatever's left over in the partnership out to the partners, that there's typically a provision that liquidating distribution needs to be made in accordance with the positive capital account balances. So one needs to make sure that that the quantitative analysis all works out, in the end, and that we're able to determine, based upon all these provisions in the partnership agreement, that we've accounted for things properly and that we know who is entitled to what with respect to cash flow distributions. And we want to know the income tax impact, of course, to each of the parties. So the summary that I have with respect to the quantitative analysis that I've referenced is that you really need to model out your scenarios. You need to determine what's the sales price, what's the fair market value of the property, and this will come into play not only if there's an outright sale to a third-party purchaser, but this analysis will come into play if you're contemplating buying out the limited partner of their limited partnership interest and continuing the ownership of the property through the existing partnership, but with a new ownership structure. Because the investor will want to go through, this analysis as well to determine, well, if we go through a sale to a third party, what am I entitled, to get out of this? So, back to modeling your scenario. What's the sales price? What's the gain or loss that would be generated on a tax basis from that transaction? Which parties are entitled to receive how much in cash from the deal? And how is the income and loss allocated amongst the partners? And ultimately, have we followed the instructions in the operating or partnership agreement? And do our allocations and distributions and everything that we're doing with respect to those partner capital accounts, have we accounted for everything properly, and is everybody ending up at zero at the end of the day?
Thank you, Mark. Mark, there have been a few questions that have come in relative to your segment. Would you like to tackle some of those right now?
I think what I'd like to do so that I have a moment to absorb them is perhaps allow Brian to move on to his segment and allow me a chance to inquire, at least read the language here, as I've admittedly been preoccupied with presenting my materials.
Sure, and we have reserved time at the end, so we will tackle those at the end of the segment, the webinar. A few questions have come in as to whether the slides are available, and they are available for you to download in the resource. If you click on the resource list, which is a widget at the bottom of your screen, it looks like an orange piece of paper. You'll be able to access the slides there. We're at our third polling question, and that is if you can identify first whether you're a nonprofit or a for-profit. Looks like the answers have already come in, and we're at about 58% for-profit, 42% nonprofit, so just about half and half, a little bit more for for-profits. And now I'll turn it over to Brian Hsu of Goldstein Hall to walk us through the year 15 considerations. Brian?
Sure. Thank you, and good morning, everyone. So my portion here will be talking about things to think about as you enter year 15. It's such a complicated process, but you got through it, and now it's the sponsor's turn to be the 100% owner. It's going to be, hopefully, if you did everything right, your project going forward 100%. And so there's a lot of considerations that you need to think about before you actually enter year 15, so that you can set yourself up for long-term ownership and be good stewards of the project. So the bad news, though, is if you're now at year 15 and you're just starting to think about it, it's probably, you're behind the 8 ball probably. We used to say that year 15 starts at year 14, which was the usually the time to exercise your option or your right of first refusal was 1 year prior to year 15. So that kind of turned on its head when there was some analysis with regard to capital accounts and getting agency consents in a timely manner. Just wasn't happening in that 1 year period. And so then we started talking about, okay, your year 15 starts at year 10, which was the end of the credit period. And then you started looking at some of this language in your operating agreements or your partnership agreements, and it wasn't that favorable. And you're thinking, oh, well, now it's really day one, starting in terms of picking your right partner, drafting negotiating the exact language that you want 15, 17 years later to actually exercise on. And so really year 15 now, we say starts at day one, and really looking at your language, looking at your partner and coming to terms and understanding what that means day one. So the top three year 15 considerations we have here: first, know your stakeholders; 2, know your documents; and 3, know your goals. So let's flip to the next slide. So your stakeholders. So your main stakeholders in the year 15 transaction, you have, of course, yourself, the sponsor. You have your limited partner, you have your lenders, your regulatory agency, and if you're a not-for-profit or even a for-profit in certain organizations, the community and residents. So with the sponsor, as a not-for-profit, you'll have a board of directors, obviously, and so you'll want to understand and have open communications and dialogue with those individuals and members of the board and your staff to figure out exactly what you need, what have the problems been up to this date, and try to figure out a long-term plan for your project. So that would probably involve undertaking a capital needs assessment to determine your immediate capital needs and any deferred maintenance that you may require. That'll generally determine your path forward in terms of whether you will need new debt, whether you can just draw down from your reserves, and figure out exactly what you need going forward. You also want to undertake a financial audit, talk to your CPAs, talk to Mark, figure out how you've been managing and operating the project. How is your M&O? Do you need to decrease certain line items? Or how is your revenue stream? Do you have a solid tenant base paying on time? Do you need to take legal action against any of your tenants, commercial, residential, or otherwise? So this is a good time to take a holistic view of yourself and the project to understand and better understand how you want to proceed going forward. So then obviously you're in a negotiated buyout scenario, or you have a good partnership agreement which you like, and so you'll want to engage your limited partner, your syndicator, for their exit. You want to make sure that you review your partnership agreement to understand the timelines, because those are important. Usually they are. The right to exercise is prior to year 15, and it does expire at certain points. So review that with your attorneys. Make sure you have those calendared. And so if we go back to that day one scenario, you'll want to understand who your partner is, and keep in mind that those can change. There are generally mission-based investors, and there's value-based investors, and there's just other investors in the space. Some are more willing than others to negotiate outside of the LPA and to benefit the not-for-profit or for-profit partner. We talked a lot about the right of first refusal, the purchase options there, and the options for a not-for-profit partner. So I won't get too much involved in that, but it's important to understand that, and also important to understand if your original partner is the one that you still have today. Most partnership agreements allow for either a full or a partial right to transfer and assign that partnership interest, whether there are carve-outs or consent requirements for the GP to allow those consents. That's a negotiated point. So engage them early on, understand what they're trying to get out of the transaction, and just have an open communication and dialogue with them early and often. So your lenders, you're going to have most likely some large existing debt, and you'll want to understand if you are going to reposition or restructure that debt. Talk to them, see if there's any prepayment obligations there. Some of you have soft debt with the governmental agency. Understand if there's consent requirements there, and understand if they're going to extend or modify any of that at this time. Also, if you're planning on getting new money, whether that new money will take out the existing debt, whether there's going to be subordination issues with respect to your other subordinate debt. So understand what each lender is looking for in your transaction. Of course, you're going to have a regulatory agency with any year 15 project. You're going to have a regulatory agreement governing the AMIs and most likely rent restrictions. And so you want to understand your allocating agency's consent process, whether they have a procedure or term sheet for preserving that project. In New York, at least, it's a pretty robust requirement, application to go through year 15. And they have at least 3 term sheets out. They used to have 4 with the resyndication, but that's no longer available for various reasons. Nationally, it could be different, and each state is different. So understand those, talk to the relevant governmental agency, and see what requirements you have there. And finally, community residents. So this is more for if there's maybe some community facility space or you have some unused space in the building. If you're planning on negotiating some AMIs or changes to rent at this time because of your project needs some additional assistance, you want to understand the pushback you may get from your community residents, politicians, and as with most not-for-profits, they want to be attentive to those needs and the potential downfalls and pitfalls with increasing rents. Just understand that as you enter this phase. The next slide we have is know your documents. So from a legal point of view, I'm going to focus here on your legal audits. So we'll first want to understand the actual compliance period. We'll start from the placement service date, and that placement service date will be in your 8609. And that's a document you get from your allocating agency telling you when your placement service date was, along with your credits that you've received or you're eligible for. So determine that, and then obviously you're going to go straight to your partnership agreement and then your amendments. The key parts have been discussed already: the purchase option versus your right of first refusal, then also your waterfall and your distributions. So I saw there was a bunch of questions about why pick one over the other. Usually, purchase option has a fair market value analysis tied to it. Right of first refusal is just the debt plus exit taxes. So when you're viewing and negotiating your language, both of those, right of first refusal, pretty generally said what's in the Section 42. Purchase option, there's a wide latitude there in terms of how you value purchase options, whether you take into account the extended use restrictions beyond year 15, if there are any. Most likely there are, and how do you determine appraisal value, appraisers, and how they obtain their fair market, what they deem fair market value. So there's a lot that goes into how you value and word the purchase option. Then you'll want to look at your regulatory agreement, your extended use agreements, other restrictions running with land, in some states called LURAs, land use restriction agreements. A lot of that will talk about what your restrictions are going forward, whether you'll need consent of the regulatory agency, and if consent is required, what conditions they will put upon you to consent to an investor exit. There in New York, at least, there's a thing called a land disposition agreement. If you get land from the city, and there's additional requirements there related to the construction and completion, anti-discrimination, other restrictions and covenants that are placed upon the project. You want to review your existing mortgages and notes, again, talking about prepayment penalties and maybe ability to assign those debts to a new lender, whether some of that debt is going to balloon at a certain time, whether it's accruing. You all want to review that and determine if you want to keep that debt or restructure it going forward. You want to, if you are planning on getting a new debt or repositioning your portfolio, you want to run a title report, understand your any outstanding liens, taxes, water and sewer charges, any judgments, any violations. It's a good time to clean that up, and so you'll understand the cost going into your next phase of your project. Status tax payments. Some of these abatements lasted only through the first 15, whether you have a pilot or you have some other abatement. And so whether that's expiring or increasingly dwindling, you'll want to either apply for a new abatement because taxes along with water and sewer are generally the most expensive parts of real estate ownership. And so that's a key part of affordable housing developments is not paying or not paying fully on real estate taxes. So after you've done that legal audit and you've thought about your stakeholders, you talk to them, you have a plan going forward, or think you have a plan, you want to understand all your options and what's the best way to take out your partner and proceed going forward. So here are 6 options. Not all of them are great options, I'll admit, but 6 options that we've generally seen in the market. What's actually not on here is re-syndications, which I've talked about a little bit. Re-syndications here, at least in New York, are not applicable anymore. The government agencies are not behind it because it's very expensive. We did have it for 4 or 5 years. They were just too expensive, and so they terminated that program. But I understand that recent cases are happening nationally, and so if that's an option for you, that may be appealing. But so for these, the first one is decouple. Decouple really is just buying out your limited partner, and that's it. Continuing your LP structure going forward. You'll probably use this or utilize this option if you have little capital needs, pretty strong revenue, strong reserves. You could use your reserves to do some deferred maintenance that you're thinking about doing. Probably don't have large structural repairs, no need for new roofs, no need for new systems. Been operating with low operating expenses and with a really good, strong project. So that is probably a good option for you there. Repositioning here generally is obtaining new governmental subsidy to extend the useful life of your projects. Usually it's for hard cost capital needs, capital improvements for your project. Again, it's still involved buying out your partner, but whether you transition that to out of the LP or you keep it in the LP, that's up to you and how you and your attorney and your accountant work together to determine the best path forward. But it's generally getting some low cost secured indebtedness to fund some capital needs. Joint venture. So you may look at when you've looked at your group and your project, and comprehensively you say, I got these certain weaknesses and or deficiencies, and I don't really want to exit the portfolio or sell it. I just need a couple things to be better at, and I don't have that staff or I don't have that knowledge. So I want to bring in some partner to help me in those particular areas, whether it be property management, collections, just development in general, whether you need maybe an immediate cash infusion which you don't want to sell, so you sell some partnership interest. All those things go into whether you think a joint venture would help you in achieving your goals. And so usually you want to bring a like-minded partner, someone you've done business maybe with in the past, someone who shares your same visions and goals for your organization and your project. That would probably be a good fit. So that's an option. Private debt. So usually in the affordable housing space, we're seeing owners get a Freddie or Fannie product or some regional local bank or even just a CDFI who'll come in and put a first debt on it, subordinate the governmental subsidy to that first debt. And that would really these transactions are for those that have large capital needs, like you said, maybe some systems, roofing, some facade work, basically more than the government subsidy would allow for. And so that should be an option that you consider. Sale, so whether you're a not-for-profit or for-profit, cash generation is always important, and whether you think it's a good time to capture some market value or some market appreciation and sell your portfolio. You obviously want to review your governing documents to make sure what that looks like from the regulatory agency point of view and your LP point of view. Take a look at your distributions and liquidation scenarios, as Mark suggested, and see whether that's even a good idea for you. And the last point is litigation. So if you end up reviewing documents, talking to your stakeholders, talking to your investor partner, and just not coming to a meeting of the minds about how to best proceed, you'll maybe have a disagreement about how something was worded in your documents, then litigation is unfortunately a course of action that you may have to take. I'm not advocating for one particular point of view or option for each group. Each group is going to have to understand what they could or cannot handle and what's best for the organization. It's up to each one of you to understand and just decide the best route for yourselves. I'm sure maybe there's some other options out there that people are doing, but these are the ones that we're seeing mostly used in our market. So I think that's all I have. Yeah, and then the next is the polling question. So that's where my presentation ends.
Thank you, Brian. Thank you, Brian. And so that brings us to our next polling question to the audience. And I'll give you a few minutes to respond. Great. And now we probably have quite a few questions coming in from the audience. And so, Mark, would you like to go back and tackle some of those questions that came in on your segment?
Yes, absolutely. So I've had a chance to review these, which there were a number of them. So let me start here. Bear with me, folks. So one of my questions is, how does one change a negative capital account to a positive one? Well, really about the only way you're going to be able to change it from being negative to positive is effectively or essentially filling it back up again. To the extent that you're going to continue allocating losses to a partner with a negative capital account, that's only going to drive the capital account even further negative. So if what you're looking to do, I mean, if the goal is to go from your negative position to a positive one, the options aren't really particularly attractive. One is that you would either fill it back up again by adding more cash into the deal in the form of an equity contribution, or additionally, the other way to increase your capital account balance is allocating gross income or gain to that particular partner, as those are the two mechanisms to increase your capital account: equity contribution and income allocation. So neither one of those is particularly attractive. But with that said, I also want to, in the interim, in considering this question, just point out you typically don't have partners in a LIHTC partnership that aren't ultimately corporations. But if for some reason you had an individual who is a partner in a partnership that has a negative capital account, you could potentially hold that asset until your demise, and your estate would get a step up in basis on that particular partnership interest, and all of that phantom income associated with negative capital account would be not subject to income taxation. But again, that would be a rare instance that, in my experience, that you would have individual partners in a partnership. So let me move on to another question. We have, what does it mean that the capital account is measured at the end of the year? Does that mean it is adjusted annually, but only once annually when it is measured? I'm going to say, generally speaking, what you described is correct, that the capital account is measured at the close of each year, each taxable year. Okay, so let's assume that our tax year is a calendar year basis. So items of partnership items are considered allocated to partners at the close of the tax year. So so if we go back to the mechanics of our capital account discussion, for a given tax year, we start off with a capital account balance that equals the prior year's ending capital account balance, and we would adjust that by any equity contributions or cash distributions. And we would also adjust it based upon the allocation of current year income and loss. So that's what hopefully I've cleared that up, but that's what I mean by it's adjusted annually and it's measured at the close of the year. If you had a sale transaction mid-year, that might close your tax year earlier than December 31st if you're on a calendar year, because your partnership may cease doing business as a partnership at that sale event, and that contemporaneously everything is considered to have happened. You've sold your property, you've made your distributions to the partners accordingly, you have effectively liquidated the partnership as of that date. So that would end up having a tax year that's a short tax year that would be ended as of the date of that sale and the liquidating distributions. So that's an instance where the measuring point in time would be something other than at the close of a calendar year. Moving on, let's see here. So we have a question: would a nonprofit general partner have to pay tax on a negative capital account? Like so many other things, I have to say that depends. For starters, there would be a distinction between whether the general partner is in fact a nonprofit, or whether this was a taxable subsidiary set up where that taxable subsidiary owns the GP interest. But I would say generally, and while I'm not a not-for-profit expert, that if your mission involves providing affordable housing, and that you have income recognition that's associated with that particular mission, my understanding is that that income is not subject to income taxation by the not-for-profit. But I want to point out that if
hey Mark,
GP,
let me
yes,
go ahead. I'm sorry. No, I was going to say
please.
A lot of investors are requiring that the GP, whether it's LLC, Inc., or nonprofit, actually declare itself as through a 168H election to be taxable entity. And so
Absolutely.
I would think that, probably they would, if they sign that. So check your documents to see if you, for your not-for-profit sponsor out there, see if you signed a 168H election.
Right. That is almost, not always, but it's almost universal that if you're dealing with a not-for-profit sponsor, that the investor would have required that you set up the GP as a corporate entity, a taxable corporation, and that entity make an election that ultimately preserves shorter life depreciation deductions, which is attractive to the investor. But one of the caveats with making that 168H election is that any income that the non-for-profit parent receives from that taxable subsidiary of the not-for-profit, that any income received from the subsidiary is considered unrelated business taxable income and may be subject to income tax at the not-for-profit level. But I should also point out that if you're considering that general partner, and the general partner has this big negative capital account, how did it become so negative? If it's a taxable entity and a singular subsidiary of a not-for-profit, the likelihood is that that there's been accumulated net operating losses over time that essentially equate to that negative capital account that it's holding. So provided the GP doesn't end up getting a significant amount of cash out of the deal, it's not likely there would be a significant income tax liability on that general partner. So moving along, All right, I'm not going to skip the tough question. I'm not entirely sure of the answer on this one. Perhaps some of my colleagues could chime in. But the question is, can the LP donate its ownership interest along with negative capital account to a non-profit to avoid paying taxes on the phantom income? I've never seen this done. I do not, without intimate knowledge of how this is potentially precluded in the income tax code, I generally do not believe that there's the ability to escape that phantom income by virtue of a donation of the LP interest. If any of my colleagues have any comment on that, I welcome their insight.
Yeah, there's talk about it, whether that's really a donation. You've been sharing this project together for 15 plus years, and all of a sudden you quote unquote donate it back. There's a question whether that's for appraisal purposes accurate, whether it's legitimate. I think it's a factual and circumstance and hard to answer. But I've heard about people do it. I've not been part of one yet. I'm not sure there's more to say on that. But I have more to say on that.
Thank you for jumping in and giving a little support on the answer. But to follow up with the person who asked the question, if you need me to provide a more detailed answer, please reach out to me in the contact information that was provided within the slides. Let's see, one more here. What would happen when a general partner has a negative capital account and there is a sale of the GP interest? So that essentially the GP would have to pick up the phantom income for those tax benefits that were allocated to them in prior years, which drove it negative. So it's really just kind of a reversal, that gain of loss items that were allocated previously. But to reiterate a point that I made earlier, there's a very good chance, if we take a look at the ownership structure, that GP was formed for the sole purposes of being the GP in that particular deal, and that the negative capital account results from losses that had been allocated to it, but have accumulated as net operating losses in the past. So that hopefully I addressed that one appropriately for your needs. And I may have one last one here. In the sample waterfall, where does the replacement reserves balance go? Is it part of the capital transaction waterfall? I think we could assume, but it may not be universal, but typically replacement reserves go along with the property, and that they're not generally available for distribution to the current ownership. So that would add to the assets that are being sold in the capital transaction.
Yeah, and Mark, to add to that, so reserves are an interesting point. A lot of these projects have very big reserves, sometimes in the millions. Mm-hmm. And so, when you look at your purchase options, usually you'll have at least two different types of purchase options. Purchase option to buy the project, and then a purchase option to buy membership interest. So, and as part of your negotiation of fair market value is, do you include reserves or do you exclude reserves? Do you take the point of view that, it's reserves are funded from cash, and it's held for the benefit of the project, and therefore it's part of the project, right? And so that's part of the value of the project. On the other hand, the GP can't really access the reserve without a third party consenting to it, and so it's not free and clear. So it's a point of negotiation, and check your documents and see what it says with respect to reserves.
Good point. Thank you, Brian. I do believe I exhausted, the questions arising out of my portion. I'll turn it over.
Thank you, Mark. Yeah, thank you, Mark. Brian, there were a few questions that came in earlier after your segment regarding some of the court cases. Did you get a chance to take a look at some of those?
Yeah, sure. So the first question was regarding the Hopkins court case. And yeah, look, it was an evaluation question, but I believe the holding is, the universal holding of what not only the lower court stated, but how it was upheld in the Fourth Department of New York. I think we covered that in our presentation. The next question came in that I saw that said, why would a nonprofit GP ever use purchase option over the right of first refusal? I don't think that's exactly what we're saying here. The purchase option and the right of first refusal a lot of times coexist within the document because a lot of times they have different triggering time frames. So if there could be a time frame before the expiration of the compliance period versus one that has an expiration sometime after the compliance period or something like that. So they're both available. If they're both available options within the contract, one may be more beneficial to be used over another one. At that time, it may just be an easier way to get out. One may not have triggered yet, and all that. And again, these are negotiation points of when you're drafting these agreements. At the inception of it, which options and what those terms are going to look like to be included at that time, and there could be different business points for each one. I believe the next one is kind of the same type of question. Why would the general partner ever agree that after the exercise of its right of first refusal would pay fair market value? Again, it's not for the fair market value portion is not for the right of first refusal. It's for the right to purchase. And again, there could be different triggering options, different triggering time periods to permit which one could be entered into at what time. And I think that was the last one I saw directed to my portion.
Okay. Brian Shu, someone wanted to get a little bit more clarification on repositioning.
Sure. So repositioning is basically you go to your governmental agency and you ask them for consent to transfer the LP interest or even the project in itself and fee to a new entity, and you ask them for additional subsidy. And in New York, it's up to $20,000 per DU, and in certain states it may be different. Maybe I heard some states don't even have a repositioning kind of term sheet or policy. It's either say yes or no to the transaction. And so in the repositioning scenario is you get additional money subordinate to all your existing debt, and it allows you to fund some capital needs at a low interest rate to allow for the low-income residents to not have their rent increase dramatically. So that's what I mean by reposition. Also, I did see a question about co-GPs. If a project has co-GPs, including a not-for-profit and for-profit, but the not-for-profit doesn't exercise its right of first refusal and desires to exit the deal, does the for-profit or co-GP fall in line for disposition options? So, unfortunately, this is one of those circumstances where you have to look at your documents, most likely in your managing member JV operating agreement, parts of the agreement, and talk about who has the right to consent to a transaction, what happens if you disagree with your co-GP, and so whether the failure to exercise the ROFR precludes you from having a say or consent in the sale. that's something that you'll have to just review in your operating agreements. It's hard to say without looking at that. There was a bunch of questions on capital accounts, so I think Mark, for the most part, handled those. I'm not going to rehash that.
I'm going to chime in here because I did come across an additional one that
okay.
Is in my realm. But we have a question: when the capital transactions waterfall and the liquidation sections of the LPA conflict, is there a template of clear language available to ensure that capital accounts are respected? That's a great question, and I regret to say that there's no clear, template of clear language available. Unfortunately, one really needs to analyze not only past performance and how things got to be where they are with respect to prior allocations, but also at some point in time when there's unclear or vagueness or what have you with respect to a partnership agreement, there are times that the Internal Revenue Code takes over and tells you in certain scenarios that regardless of the language in your operating agreement or partnership agreement, that the mechanics of the income tax code kick in and take over, at some point in time. So, unfortunately, I can't provide an easy answer when there's a scenario like that. But instead, you just unfortunately need to really parse the language of the agreement and how interplay of the income tax code may be prevailing with respect to current year allocations.
Actually, now I'm seeing there was another question I could probably address here. Is the dissolution of LP in year 15 always an acceleration event for the existing hard debt lender to the project? So if you're just keeping the LP structure in place and just dissolving it for tax purposes, doing your final tax return, I don't think that's a acceleration event. But if you're just replacing the LP partner with a new affiliate of a not-for-profit partner or your for-profit partner. But if your plan is to transfer and fee out to a new entity after your year 15 exit, then yes, that would be an acceleration event. But most of the time, assuming the sponsor does it correctly, they ask for the consent of the lender, and it's basically a mere change. And so the lenders hopefully would agree to consent to that type of transaction, considering nothing really has changed. We're just taking out the partner. And then in your experience, what percent of the time does the existing hard debt lender keep its debt to the project in place, either through maturity date extension or loan restructuring after year 15 occurs? So most of the debt that I've seen at PERM is 30-year debt. Freddie has a 35-year, 30-year probably with 35-year amort now. Some are doing 10 years at year 15. But I think a lot of the older projects, 15 years ago and plus, had 30-year debt. So it's not really a problem at this time, whether it stays on or not. Whether you want to pay it off and take on new debt that's more attractive considering the interest rate environment, that's something that you'll have to review internally and see if that makes sense. But most of the time, that hard debt in the year 15 transaction just stays.
Thank you, Brian. So we're nearing the end of our webinar time, and just wanted to go over a few housekeeping items that I mentioned on the beginning. But you will be able to download the slides if you access the resource button at the bottom of your screen to the left, and you will get CPE for the session if you listened for 75 minutes and answered 3 out of 4 of the polling questions. I want to thank our panelists, Brian Hsu, Brian Markowitz, and Mark Kavanaugh for their presentation this morning and for answering your questions. If we didn't get to your question, we'll be sure to do so as a follow-up directly to you, but we want to be sure that we do answer all of the questions. And our last polling, in our last polling question, there were a significant amount of people that, we're in the midst of doing this evaluation or assessment. And so if you need help and have questions, please do not hesitate to follow up with the professionals at Goldstein Hall or CohnReznick. We're here to help you. And again, thank you for joining us this morning, and thank you for tuning in, and we hope you enjoy the rest of your day.
Thank you for having us.
Thank you very much.
Thank you.
Thanks, everybody.